Section 1. The truth about your first $100. Let's start with a simple, powerful idea. If you invested just $100 and left it alone, it could become over $700 in 30 years, assuming a modest average return. This isn't magic, it's the fundamental principle of compound growth. Think of it as a tiny seed. At first, its growth is almost invisible, but over time, that seed sprouts, grows roots, and becomes a sapling. With enough time, it matures into a strong, towering tree. Your money works the same way. The initial $100 earns a return. The next year, you earn a return on your original $100, the return from the first year. Your money starts making money, and then that money starts making its own money. It's a quiet, patient process that builds on itself, accelerating dramatically in the later years. That single fact is more important than almost any other investing advice you will ever hear. Why? Because it contains the entire philosophy of successful long-term investing in a single sentence. It teaches you about patience, the power of time, and the irrelevance of starting big. It's the antidote to the get-rich-quick schemes and the market noise that distracts so many. It proves you do not need to be wealthy to begin building wealth. This is a profound mental barrier that holds countless people back. We see the finish line, the million-dollar portfolios, the comfortable retirements, and we can't imagine how to even take the first step. The journey does not start with a lottery win or a surprise inheritance. For the vast majority of financially independent people, it didn't start with a stroke of luck at all. It starts with a small, deliberate step, a conscious choice. It's the decision to pay your future self first, even before the coffee, the subscription, or the takeout meal. It starts with deciding your future self is worth investing in, even if the amount feels insignificant today. That future person, the one who will want to retire, handle emergencies without stress, or have the freedom to choose their path, is counting on the small sacrifices you make now. That $100 isn't just $100. It's a vote of confidence in the person you are going to become. This is the unglamorous truth of how most fortunes are slowly built. They begin with a number that looks too small to matter. They are built not in dramatic leaps, but through consistency. $100 this month, maybe another $100 next month. The process is often boring. It lacks the adrenaline of a risky bet, but it is reliable. It is how brick by brick, a fortress of financial security is constructed. Yet, so many people are paralyzed by the idea of investing. They see headlines about billionaires, complex financial products with cryptic names, and endless commentary about market crashes and bubbles. The entire world of finance is often presented as an exclusive club, a high-stakes game played by experts in skyscrapers. The language is confusing, the stakes seem terrifyingly high, and so they assume the game is not for them. They believe they don't have enough money to start, that they lack the expert knowledge to succeed, or that they'll inevitably make a costly mistake. This is a story we tell ourselves, but it is not reality. It's a narrative crafted by a media that thrives on drama and an industry that once profited from exclusivity. The real story of investing for most people isn't about outsmarting the market or picking the next big stock. It's about participation. It's about owning a tiny slice of the world's greatest companies and allowing your wealth to grow as they do. Modern technology has completely dismantled those old barriers. It has opened the doors for everyone. You no longer need a tailored suit or a meeting in a skyscraper. You don't need a personal broker or thousands of dollars to meet an account minimum. You just need a phone, an internet connection, and a small amount of money you are willing to set aside for your future. The tools of wealth creation are now, quite literally, in the palm of your hand. Your first $100 is not just money, it is a ticket to the game. It is your entry pass. It's the proof you need to show yourself that you can do this. It transforms you from a spectator watching from the sidelines into a player on the field. And once you're in the game, everything changes. You start to learn the rules, you begin to understand the flow, and you realize that winning isn't about making spectacular plays every day, but simply about staying on the field for the long run. That first investment, no matter how small, is the most important one you will ever make, because it's the one that gets you started. Compounding is a simple idea that often gets mistaken for something complex. Your money earns a return, and then those returns earn their own returns. It is a snowball effect. At first, it is tiny. You roll it. It picks up a little more. It feels slow and unproductive. As it gets bigger, each rotation collects more. Soon, it seems to grow on its own. This is what happens when your money stays invested over time. Imagine you invest $100 one time, earning an average 7% per year. After 30 years, it becomes about $760. Change one thing. Invest $100 every month. At 7%, after 30 years, you would have over $120,000. You put in $36,000. The rest, over $84,000, is compounding. The key ingredient is not the amount. It is time. Starting early is a massive advantage. Begin with small sums sooner, and you can end up with more despite investing less of your own cash. Your financial North Star. Why goals matter most. Before you invest a single dollar, ask, what is this money for? The answer is your North Star. It guides every decision from here. Investing without a goal is like setting sail without a destination. You might move, but not toward anything specific. Knowing your goal tells you what investments to choose. It tells you how much risk to take and how long your money should stay invested. It brings clarity to a confusing landscape. Break goals into short-term, medium-term, and long-term. Short-term, 1 to 3 years, like a vacation or emergency fund. For short-term goals, take little risk. Use a high-yield savings account. Medium-term, 5 to 10 years, like a home down payment. Long-term, retirement can take decades. You can take more risk. An emergency fund is not an investment. It is financial armor. The 5 simple steps to your first investment. Getting started is far easier than you think. The industry wants it complicated. Here it is simplified. A clear plan to go from $100 in your pocket to being an investor. Step 1. Build a small safety net. Save at least $500 in a separate savings account. It prevents tapping investments when the market is down. Non-negotiable. Step 2. Open an account. This is where your investments live. Brokerages often have no minimums and zero commissions. Modern apps are simple. Robo-advisors build and manage for you. It usually takes less than 10 minutes. Do not chase the next big thing. That is gambling. Choose a broad, low-cost index fund or ETF, a small slice of hundreds of companies. An S&P 500 index fund spreads risk across large U.S. companies. Put it on autopilot, $25 weekly or $100 monthly. Dollar cost averaging removes emotion and builds consistency. Once your account is open, what do you buy? Options seem overwhelming, but they boil down to a few categories. Safest, a high-yield savings account. Not an investment, great for emergencies and short-term goals. It pays more than standard savings, helping cash keep closer to inflation with minimal risk, limited growth. For long-term growth, a low-cost index fund ETF. One share gives exposure to many assets. An S&P 500 ETF copies the market of 500 large U.S. companies. Instant diversification at low cost. What if a single share costs more than $100? Use fractional shares. If a fund costs $400, $100 buys a quarter share. No investment is too expensive. A robo-advisor builds and manages a diversified ETF mix based on your goals and risk tolerance. It handles rebalancing automatically for a small annual management fee, around 0.25%. Those are the basics to consider. With as little as $1, fractional investing makes diversification accessible to everyone. Keep it simple. Choose the vehicle that fits your time frame and comfort. Every investment carries some level of risk. This is a fundamental law of finance. To beat inflation, you must accept that values can go down. Risk and reward are two sides of the same coin. You cannot have one without the other. Avoiding risk entirely guarantees you lose to inflation. Stocks represent ownership in a company, highest long-term growth potential, and the most volatility. Prices swing on company news, economic data, and market mood. Bonds are loans to governments or corporations, generally safer, with predictable income but lower growth. Many investors balance both. The biggest mitigator of risk is your time horizon. Longer horizons can take more risk. Over long periods, markets have recovered and trended upward. Short timelines cannot wait for recoveries. Use low-risk options. There are no guarantees. Accept uncertainty and volatility without panic. Fees are a small but powerful force working against your returns. They look tiny, fractions of a percent, but over decades, the impact compounds against you. Think of them as a slow leak. You lose the fee and the future growth on that fee. The common fee is the expense ratio on mutual funds and ETFs. 1% equals $10 per thousand per year. A low-cost index fund at 0.05% is 50 cents. A massive difference over 30 years. Watch for trading commissions, robo-advisor management fees, maintenance, transfer, and inactivity fees. Read the fine print. Choose transparent, low-cost options. Competition has driven costs down. Global portfolios under 0.1% are possible. More of your money stays invested. Fees are one thing you can fully control. Starting with $100, fees seem trivial. But as balances and years grow, choosing low-cost funds pays off enormously. It's a well-known saying among seasoned investors, and it holds a profound truth. More money is lost trying to react to the market than in the downturns themselves. Think about that for a moment. The real damage isn't caused by the temporary drop in prices, but by the permanent losses locked in through panicked, emotional decisions. It's the frantic selling when things look bleak and the desperate buying when everyone else is euphoric. These gut reactions, driven by the primal instincts of fear and greed, are the single greatest threat to your long-term wealth. Ultimately, investing is a mind game. It's not you against the market. It's you against yourself. Your emotions are the biggest enemy. Our brains are wired for survival in the short term, not for the patient, counterintuitive thinking required for long-term investing. This wiring leads to cognitive biases that can sabotage our best intentions. We feel the pain of a loss twice as intensely as the pleasure of an equivalent gain, a bias known as loss aversion. This makes us terrified of seeing our portfolio in the red, even if it's just a temporary paper loss. When markets soar and everyone seems to be getting rich overnight, the fear of missing out, or FOMO, kicks in. It's a powerful social pressure that tempts you to abandon your strategy and chase risky buys at their absolute peaks, often just before a correction. Conversely, when markets crash, fear and panic spread like wildfire. The instinct is to flee, to sell everything to stop the bleeding. This herd mentality pushes people to sell at the very bottom, crystallizing temporary downturns into permanent devastating losses. You've effectively sold low after buying high, the exact opposite of the goal. So, what's the antidote to this emotional roller coaster? The key is to create a simple, written investment plan and stick to it with unwavering discipline, deliberately ignoring the daily noise. This plan is your anchor in a stormy sea. It should outline your goals, your time horizon, and your strategy for how much you'll invest and how often. It's a contract you make with your future self to protect you from your present self's emotional whims. To stick to your plan, you must understand that the financial news is not your friend. Its business model is not to make you a better investor, it's to capture your attention. It sells drama, urgency, and bold predictions, not the boring but effective message of long-term discipline. The headlines are designed to provoke an emotional response, fear or greed, because that's what keeps you watching. Watching your portfolio's value change tick by tick is a guaranteed recipe for anxiety and bad decisions. Every flicker of red will trigger your loss aversion. Every surge of green will tempt you to get greedy. This constant monitoring shortens your time horizon from years or decades down to minutes and seconds, forcing you into a trader's mindset when you should be an owner. So, how often should you check? Great investors often check their portfolios surprisingly infrequently, perhaps once a quarter, or even just once or twice a year. This isn't neglect, it's intentional. The purpose of these check-ins isn't to react to market moves, but simply to ensure your investments are still aligned with your long-term goals and to rebalance if necessary. By stepping back, you give your strategy room to breathe. You let time and the power of compounding do the heavy lifting for you, smoothing out the bumps along the way. The most powerful tool to enforce this discipline is automation. Set up automatic monthly or weekly investments into your chosen funds. This strategy is called dollar cost averaging, and it's your secret weapon against emotional investing. The logic is simple and beautiful. When prices are high, your fixed dollar amount buys fewer shares. But when prices fall, that same fixed amount automatically buys more shares at a lower average price. You are systematically buying low without having to think about it. It's rational behavior on autopilot. Automation takes your emotions completely out of the driver's seat. The decision is made once, up front, based on logic and your plan. After that, the system executes for you, whether the market is up, down, or sideways. This brings us to the final, crucial principle. Always tie your decisions back to your goals, not to the market's daily whims. Ask yourself, has my goal changed? Has my 20-year timeline for retirement suddenly become 2 years? Almost always, the answer is no. If your financial goal is decades away, a scary-looking double-digit drop is just a temporary blip on a very long journey. In fact, for someone who is regularly investing, a market drop is a gift. It's a sale. It's an opportunity to buy quality assets at a discount. The winners in the long run are not the fortune tellers who try to predict the next crash or rally. They are the disciplined, patient investors who create a sound plan and have the fortitude to stick with it, especially when it's hardest to do so. Reading is good. Taking action is better. It's easy to get lost in a sea of financial advice, consuming endless books, articles, and videos, all in the pursuit of the perfect strategy. But the truth is, perfection is the enemy of progress. The single most powerful force in building wealth isn't finding a secret stock tip or timing the market flawlessly. It's the simple, unglamorous act of starting. The most important thing you can do is start. And you can start right now, in the next 10 minutes. The journey from where you are to where you want to be financially is paved with small, consistent actions. It's not a leap across a chasm. It's a series of manageable steps. You do not need to know everything. Just enough to take the first step. The fear of making a mistake can be paralyzing, leading to what's called analysis paralysis. You feel like you need to understand every financial term, every market fluctuation, every possible outcome before you invest a single dollar. But investing is a skill you learn by doing, not just by studying. Do not be stuck in the gap between knowing and doing. Your future self is counting on you to bridge that gap today. Every day you wait is a day you lose the powerful effect of compounding, where your money starts earning money for you. Let's walk through the exact steps to get you started. This isn't theory. This is a practical 10-minute plan. Step 1. Identify $100 you can invest. Look at your budget. Maybe it's the money you'd spend on a few fancy coffees, a dinner out, or a subscription you don't use. Find it. If $100 feels like too much of a stretch right now, start with $25. The amount is less important than the action. The goal here is to prove to yourself that you can do it. Step 2. Open a low-cost investment account. You have several great options. A traditional brokerage account gives you the most control. A user-friendly app simplifies the process, making it feel as easy as online shopping. Or a robo-advisor can manage your investments for you based on your goals. For your first account, prioritize low fees and a simple interface. A quick search for best beginner investment apps will give you plenty of reputable choices. Have your government-issued ID and social security number ready. This is often the biggest hurdle for people, but it's a standard identity verification process. You can have it cleared before you finish your morning coffee. Step 3. Transfer your $100. Link your bank account to your new investment account, a secure and standard process, and initiate the transfer. Seeing that money move from your checking account to your investment account is a powerful psychological shift. You are now officially funding your future. Now, make your first investment. Don't try to pick a single winning stock. Instead, buy the whole haystack. Choose a broad, low-cost index fund, like one that tracks the entire US stock market or the S&P 500. This instantly diversifies your money across hundreds of the largest, most established companies. Look for funds with very low expense ratios, preferably under 0.1%. This is the tiny fee you pay for the fund to be managed, and lower is always better. One share of an index fund might cost several $100s, but that doesn't matter. Use fractional shares. This feature allows you to invest by dollar amount, not by share count. You can buy $25 or $100 worth of that fund, even if a full share costs more. Find the Trade or Invest button, enter your dollar amount, select your fund, and click Buy. Congratulations, you are now an owner. You own a tiny piece of hundreds of companies. You are an investor. Take a moment to let that sink in. You've crossed the most important threshold. You've moved from thinking about it to doing it. Step 4, and this is crucial. Before you close the app, set up an automatic investment plan. Find the Recurring Investment or Auto Invest feature. Schedule a transfer of $25, $50, or $100, whatever you can comfortably afford, to be invested automatically every week or every month into that same index fund. This single step builds real wealth. It automates your success. Investing becomes a habit, like paying a bill, not a one-time event you have to find motivation for. This strategy, known as dollar cost averaging, means you buy more shares when prices are low and fewer when they are high, smoothing out your returns over time and removing the temptation to time the market, which is a losing game for most. You did it. You found the money, opened an account, made an investment, and automated the process. You started. That is everything. You've built the foundation. Now, let time do the rest. Your job isn't to check it every day. Your job is to let your plan work. Let the world's greatest companies innovate and grow, and as they do, your ownership stake will grow with them. This is the simple, proven path to building long-term wealth. You're on it.